Out of these three charts, which one would you say is the best investment? Well, it's not this one. In this video, I'm going to show you why one of the most popular stock market investing strategies, dollar cost averaging, is also one of the most effective approaches for CS2 investors. We'll go through a couple of clear examples to see why it is superior and why Valve's trade protection update might actually be a blessing in disguise. If you're not familiar with dollar cost averaging, the idea is pretty simple. Instead of putting your money into an investment all at once, called a lump sum, you spread it out over time. For example, buying each week or month, regardless of whether prices go up or down. In the stock market, this helps reduce the risk and stress of trying to time the market, and it smooths out your average cost in the long run. But you can actually apply this exact same strategy to CS2 skins. If you believe in the long-term growth of the CS2 economy, maybe because of rising player numbers, limited item supply, or discontinued cases, instead of throwing $1,000 into skins right now, you could spread that investment over, say, 3 to 6 months, buying smaller amounts consistently. So here's why DCA is such an effective strategy. CS2 skin prices fluctuate just like stocks or crypto. We might see spikes when new content drops, or dips when hype dies down or an unusual update shakes confidence, just like when the trade protection system was introduced. By using DCA, you're automatically taking advantage of those price swings, buying more when prices are low and less when prices are high, which lowers your average cost per item. Let's take our initial example with items A, B, and C. I think most people would look at these price graphs and assume item A, the blue line, makes the most money. I mean, it clearly has the highest price by the end of the year. But let's break it down. Let's say we invest $12 every month for the year. That's $144 total. The number at the top indicates how many of each item we could buy that month. For example, in January when item A costs $2, we can buy 6 of them. Then in February when it increases to $3, we can buy 4 of them, and so on. It looks like a strong performer. We buy and the price goes up. A small dip, but we buy and the price goes straight back up. It goes up again in August and has a big spike in November. By the end of the year, we have 54 units worth $6 each for a total of $324. Not bad. If we follow the same process for item C, where it fluctuates for the first few months, drops hard to 50 cents for 4 months, and then ends the year at just $2, you'd think that's terrible, right? But because we kept buying when it was cheap, we end up with 162 units, also worth $324, exactly the same as item A. Finally, we have item B, which starts off strong, increasing to $3, then plummeting down over the middle months to 50 cents, and coming back up steadily at the end of the year to finish at $3. Looks pretty average, but we get a total of 124 units at $3 each, worth an impressive $372, the actual winner of this scenario. Many people around the July and August months would be tempted to sell both item B and C and put their money into item A, but this would be a huge mistake, as you'd have lost a significant portion of your initial capital and buy-in at a premium. Of course, this is a simplified example, but it's interesting to see. If we had instead invested all our money upfront, a lump sum, things could have gone quite differently. We'd have purchased 72 units of each item, and at the end of the year, item A would be in the lead worth $432. Item B would be worth $216, and item C wouldn't have moved at all, back at its starting price. But if we had entered in lump sum in August, we'd have just $216 for item A, $864 for item B, and $576 for item C. There's huge variation there, and good luck predicting when the perfect time is. Of course, in retrospect, it's easy to look at a graph and pick, but in the moment, how do we know when we've hit the low, or a spike is inbound? Sometimes factors like updates, time of year, streamer hype, or new skin content can impact prices, but this requires both extensive knowledge, ongoing monitoring of the scene, and honestly, an element of luck. Dollar cost averaging will not necessarily give you the biggest potential return, but it is a consistent method to bring in profit when the market is tracking well and take advantage of downturns in the long run. Let's now take a look at a real example. Many players consider cases to be a good investment, and according to this study, they are nearly on par with Bitcoin, offering up 66.6% returns per annum on average. If we take a look at the glove case price over 2024, most people would say this is an ideal investment. and there's absolutely nothing wrong with it. I myself have held glove cases for years. Let's also add the Prisma case and Breakout case. I've removed the price axis as these graphs are just relative, not exact values, as we're working on completely different price scales. However, we can see once again that if you had spent your entire investing balance in January, you wouldn't have moved much with the Prisma case by the end of the year. You'd be up a bit with the Breakout and up significantly with the glove. But if you'd started buying in August instead, you'd have made the most with the Prisma, lost money on the Breakout, and barely broken even on the glove. Same items, but totally different results. You just can't time it perfectly. I think this is also important to demonstrate that it is not always worth panic selling just because an item is decreasing in price. If the fundamentals are there and you've done your research to understand demand, drop rates, and believe the item will do well long term, dips are just an opportunity to buy in at a discount. If we had spent $50 each month on glove and Prisma cases in 2024, we'd have ended up with 137 glove cases, but 1,365 Prisma cases thanks to the lower price point and buying in throughout those months where prices were decreasing. Looking at the price of those today, the glove cases would be worth $1,567 and the Prisma cases would actually be in the lead, worth a total of $1,829. I understand it takes more effort to periodically purchase items than to do it in one go. We don't have investing apps that can automatically take money out of your bank account on a recurring basis to purchase items, but depending on the volume of your investments, it might actually now be something you're forced to do. With the trade protection update, you are limited to accepting 1,000 items from trade offers in any 7-day period. So unless you buy everything on the Steam market, which does allow you to move items into storage units right away, you're now forced to spread purchases out. There are some ways to bypass this to some degree, like having alt accounts or purchasing items on sites that actually let you store skins on the site's bots without having to withdraw them immediately on purchase, but it's significantly more effort than before. But given everything we've just spoken about, it might not be such bad news after all. I mean, can we really confidently predict when exactly the market might crash or reach a new high? Or when a certain hype cycle will begin or end? If we stop trying to time the market and just buy in little by little over months and years, we will set ourselves up to do well and eliminate that emotional stress that can plague us. I've shared 9 free tools that are essential for every CS2 investor, so be sure to check out this video next. Please leave a like if you enjoyed and take care of yourselves.